Hello, everyone. Hi, my name is Michael. I work for Finanzwende and will be your host tonight. And while there's still some people dialing in, I'll sort of start with setting the scene a little bit. We have been working on a couple of different reports here at Finanzwende, all related sort of on finance, financialization. And yeah, we already had one webinar on topic around private equity. And today we'll actually be talking financialization of the firm, financialization of public companies. And yeah, with me today to talk about that is Caroline from France, from OXFAM France. Caroline is working there as policy officer. Oh, I think I just opened the wrong screen. Let me do it this way. Here we go. Yeah, used to be a financial auditor and also a former humanitarian worker, and has been working with OXFAM France for 2 years as a corporate governance, transparency, and accountability advocacy officer. And yeah, we'll focus on the extractive sector. And yeah, we've actually been exchanging work notes with each other for quite a while here, because some of the work that you guys have done on the French index, the largest index of publicly listed companies, the CAC 40, we did a sort of similar study here in Germany. So yeah, welcome, Caroline. Hi.
Thank you. Hi.
Good to have you. And yeah, so before we sort of jump in to the webinar, I wanted to give you a few notes on the structure. Let me go back. And yeah, actually today presenting this work with us is not just Finanzwende, but also Heinrich-Böll-Foundation and OXFAM Germany, who are basically co-hosting this webinar with us, and have also helped with the report. The report that I will present later is a joint work of Finanzwende and OXFAM Germany, and is a product of a project that Heinrich-Böll-Foundation and Finanzwende host together. Yeah, and so today, just a couple of slides at the beginning for intro, and then we'll jump right in with the presentation from Caroline, and then I will present some facts from Germany, and then we can start into a discussion and QA. So basically, we'll have two inputs, both on sort of the state of the CAC 40 and the DAX 30, and what has happened there in the last 10 to 15 years. Just one quick note for all of you. There is a question and answer a symbol at the bottom where you can write your questions in there, and we will collect them. And after the two presentations, we'll sort of have a section where we can address questions of sort of understanding directly, and after that we'll jump into a discussion between Caroline and I, and sort of use the questions from the audience to jump off from there. And then just two notes that I wanted to mention at the beginning. This is a report that colleagues of mine have published recently, which is part of this publication series I've been working on financialization. This one is specifically on private equity companies in the healthcare sector, in old folks' homes and care homes, and it compares cases from France, Germany, and the UK, and highlights sort of what happens if private investors go and buy care homes. Especially in the current health situation that we've been living in for the past year and a half, a very important topic. And today, Finanzwende, and my colleagues will post this in the chat so that you can also access the studies there. And just today we published, actually this one is only in German, but it's on a study on ESG investing and greenwashing, and how a lot of the funds that you can invest in claim that they are doing ESG investments, so particularly focused on environment, social, and governance issues, but in reality they're doing things very similar to other funds. And so quite interesting. We just published this today. Have a look. And and without further ado, I would actually pass over to Caroline so she can sort of start presenting her slides on the work you guys have done on the CASA 40. And you just tell me when to click to the next slide, and I'll start with the first one now.
Yeah, thanks, Michael. So I'm gonna expose to you like the results and the methodology we followed in our report that we published in 2020, and a report that we called "Profits Without a Tomorrow." So that gives you a sense of like what we focused on, and like we try to shed a light on short-termism versus long-term issues and tomorrow's issue maybe. So that gives you a sense of where we started. But before we get into this report, so if you can go on to the next slide, Michael. Yeah. So before we go on into this report in particular, the last one, just to give a little bit of context to this report that was published, like I said, in 2000. It's not too. Sorry, there's somebody telling me, but I'm. Can you hear me all? It's fine?
Yeah.
Okay.
I can hear you fine.
Okay. Sorry. There was a comment that made me think that you could not hear me. Okay, I can hear you fine. That's great. So just to give a little bit of context, this report was actually the second of a series of reports that we started in 2018. So in 2018, we published a first report that we called Profits Without Sharing, the profits sans partage in French. And where we focused at the time, we focused on the distribution of profits. So really the bottom line of the profit and loss of a company between workers and shareholders, but also on CEO to worker wage gap. So that was our initial focus. And this report, I'm mentioning it because this original report we did in 2018 took place in a context where the role and of large corporations in society in general, like was really debated and discussed in France, as there was legislative work in progress on the Loi Pacte, the action plan for the growth and transformation of companies. So around that time, like many discussions took place in France, and so essentially, like our original report, the first one of the series, really, tried to inform that debate. And so our original finding in this first report were that companies tend to allocate the most of their annual benefits to shareholders, but and probably not sufficiently enough into longer term investments. Also, just to note out of context that as a result of this legislative work, the civil code and the role of corporations in France was changed in the law with the addition of so this sentence that you can see on the presentation that says that companies need to take into consideration the social and environmental issues from their activities. So the question that we can ask now is whether this is effective enough and whether companies and large corporations have effectively changed. So that's a debate in France, but it's also a debate in other countries and pretty much all around the world, because we seem to see an apparent change in paradigm and companies declaring that that they have moved on from Milton Friedman and the business of business is business. And we have seen, like in recent years, like many declarations on multinational companies and how they want to be more responsible. So in 2020, we decided to take another look after this legislative work, and see whether we could go a little bit deeper in our analysis and really see if companies and capitalism has really changed or is about to change. So if you can go on to the next slide. Thanks. So in 2020, so in this report that we called Profits Without a Tomorrow, we decided to extend the scope of our analysis and really look this time not only at the company's bottom line, profits distribution, but also to look into the distribution of added value within the company various stakeholders that you can see here on the left hand side of the screen, where we try to summarize, and sorry because that's in French, but the different stakeholders of a company, those that receive parts of the value of the added value that's created by the company. So that includes workers, but also the states and banks and those that make loans to companies. So we started from wanting to have a closer look at the distribution of added value. And we also, again, calculated payouts ratios and the distribution of profits to shareholders as compared to how much goes into reserve. So if you can go on to next slide, Michael. So those are the results of our analysis on a decade of financial indicators as published by companies of the CAC 40. We only looked, at non-financial companies. So that's basically 36 companies that are not banks. And so those are the results of the distribution of added value. So what we saw is that on average, wages, so if you only look at the share of labor as compared to capital share, like what we saw is that payouts ratios continued to remain pretty high. This finding is actually very much in line with the finding of our previous report from 2018. We also saw that wages on average seem to have increased by 20%, but actually that's the same increase as inflation. So there's no real increase in reality. And we also looked at CEO remunerations, and we saw that over the past decade, they had increased by 60%. We also looked at the wage gap, which is something we had calculated before as well. And we saw that it had increased from 86 on average in 2009 to 110 in 2018, with the lowest being around 19 for EDF, that's the national electricity company in France, and the highest being Carrefour, the supermarket chain company, and close to with a gap close to 500. So if you can go on to next slide, Michael, thanks. So because we decided to broaden the scope of our study, we were also able to look at how companies direct the added value that we create to investments, and especially into the energy transition or not. So what we saw is that investments measured by the proxy of amortization and yearly amortization expenses had actually decreased by 5%. But we also we tried to have a sense of how much in stock like that actually, like those investments actually represented, and how much could have been shared into the energy transition. And so what we know, we started from the fact that we know that investment needs to at least double to achieve the objectives of the Green Deal across the EU. And we were able to calculate that should have dividends be capped at 30% of profits, so a payout of maximum 30%, around 27 billion euros could have been reinvested each year by CAC companies into the energy transition. So if you can go on to the next. I'm going to be quick on this, but we also looked at the distribution of powers in general, essentially like who are the people who are in charge of CAC companies, what's the profile in terms of diversity and expertise among board members. So essentially, one of the findings is that only 12% of board members are workers in 2018 and that's actually an increase from 2009 as a result of the PACT law that I've mentioned. But still, it's like nowhere near what we think is transformational enough. We also saw that the dominant expertise among board members is finance, which we think is an interesting observation that can also shed some light on the type of decisions that are taken in board. In France, a law on women in board was introduced in 2011, and that actually resulted in an increase in the number of women in boards. So if you can go on to next, Michael, please. So after the report, a couple of observations. So this report was released So about a year and a half ago, we went a little bit deeper in the type of analysis we could produce to shed light on a distribution of added value, and especially with a focus on long-term investments versus short-term approaches in particular. What was interesting to note, I think, is that around, not that, you know, the two are completely not connected, but it was interesting to note that 1 month later, the European Commission published its study. That's a study that was conducted by Ernst & Young on directors' duties and sustainable corporate governance to inform the Sustainable Corporate Governance Initiative, which was initiated somewhere around March 2020. And so in this study, the findings are actually very close to ours, and the observations actually confirmed what we have observed in France in particular on a sample of EU companies across a 25 years period. So essentially, like, they found that payouts had been increasing in the European Union the past 25 years, and that has happened at the expense of sufficient investments, in particular into the energy transition. We also published another report a little bit later that focused in particular on CEOs' remunerations. That's one on the bottom right, and where we looked at structures of remunerations and how much incentive do CEOs have to actually take decisions for sustainability matters. And so the conclusion that we found was that there is very little incentive, as almost 70% of their overall remunerations, that's for the CAC 40 again, is actually linked to financial objectives only. So just to finish, our recommendations at this point, that so the recommendations that we have made after the publication of this report is that there is a need to move on from vague approaches such as WAP Act that I've mentioned at the beginning, and actually go into procedural changes and clarifying what are the steps, concrete steps that companies need to take in order to be more sustainable in the way they approach corporate governance. And so that includes ensuring board oversight, appropriate board oversight on sustainability issues, regulate sustainability objectives, climate objectives in particular, and do not only rely on voluntary approach, link payment of dividends to sustainability targets and climate in particular. And finally, as I've mentioned, review incentive structures and CEO remunerations. Thank you.
Thank you so much, Caroline. This is really, really good. And I mean, relates in a lot of ways to what I will be talking about in a little bit, that it's just sort of very similar trends that we see both in France and in Germany. And I'm happy to chat more on that. And then maybe now I will just directly transition into the presentation that I've prepared. And then afterwards we can start taking questions and join into the discussion. And yeah, so basically we did this project together. So the study is called DAX 30 Profits at the Expense of People and Planet. And this is what the report looks like. My colleagues will also push the German and English version in the chat so that you can take a look at the report yourself if you would like to. And yeah, as you can see, this report was actually inspired by the work that OXFAM France had already done. And yeah, together with OXFAM Germany, Finanzwende has looked at this. And as I mentioned before, this was part of the Transformative Responses project that we're doing together with the Heinrich-Böll-Foundation. We looked at the DAX 30 in the past 12 years, so also since the financial crisis, to sort of look what has happened since. Has anything changed? Has trends just continued? And yeah, I've looked at the 30 largest companies. So yeah, you know, now the DAX is actually 40 companies ever since September, but we were obviously looking at the past, so that doesn't really matter to us. And yeah, first of all, I can sort of support the same claim that Caroline has also made. You can see that the payouts, so dividends and share buybacks, the money that was being distributed to shareholders has increased significantly in the time, increased by 85% actually, while at the same time the profits only increased by 48%. Overall, you can say that this entire period between 2009 and 2020 was very positive for all the DAX companies. So they made a lot of profits, but from all those profits that they made, they have actually distributed even more than than they made. So you can see a larger part of the pot is being paid out. Okay, what else is happening with the profits? So they're not just paying out the profits, but they are also holding them and saving them in a way. So you can see that the cash holdings and bank balances have increased significantly. So we've called this the total cash and short-term investments, cash and cash equivalents. They have increased significantly. So we've you can see this graph for the entire time frame. Only in the last 7 years, there was an increase of 61.8%. And that is 75 billion more, and now a total of 200 billion euros between these 30 companies that is sort of sitting around and waiting to be spent. And now you might wonder, okay, why is this important, or why are they doing that? Well, it seems like, and one answer would be that they don't really know what else to do with it. And while they're saving it themselves, at least that is actually good for the stock price. So you have more money in your company. That is also good for the stock's value and good for the shareholder value, which is something that we will be discussing a little bit more later. But you might have heard of that before. If not, we can also go into detail a little bit more. We looked again at these payouts. So what company is paying out what? So I know this screen might be a little small, but I can explain. And you only really have to look at the amount that is purple and the amount that is colored in red. And so you can see on the left-hand side, like all the 30 companies that we looked at, and on the right axis, you can sort of see the years since 2009. And for each year, we've looked at, okay, how much did they actually pay out these companies, and how much profits did they make, and calculated a ratio of this. And so what you can see is that in the purple cases, companies paid higher dividends than what they earned in that year. So they are paying out more than they earned. And in red, companies paid dividends even though they didn't earn anything in those years, even though those were loss years. So you can see there's a trend to sort of distribute earnings, or not even earnings, but distribute sort of money, even though it might not necessarily be there. And so this is something that Caroline has, I think, briefly only touched upon, but I know that you looked at this also for France, and that there are some companies that even go into debt to actually pay out this money. So they sort of try to reward shareholders. And this is something maybe we can talk about later also, where you can see that, or you can at least assume that some pressure is there from financial markets to take out money from these companies, even though this money might not be there. We also looked at wages, similar to what the story that Caroline was telling. You can see that if you plot these payouts next to the personnel expenses, the wages, you can see that the personnel expenses increase only slightly, while the payouts increased substantially more. So that does tell you a little bit the picture of how the money is being spent. Because obviously you can save the money, you can pay it out, you can reinvest it. So those are three options. Those three options are all good for the stock price usually. The fourth one, paying out higher wages, not necessarily good for the stock price. That's most likely one of the reasons also why it's not being done so much in practice. But also happy to discuss that. And then now also to sort of the last bigger point that we also looked at is there more investment needed? Of course, there's a lot more investment needed. We looked at EU numbers that calculated for different sectors how much more they need to invest to achieve certain landmarks. So to achieve the current 2030 goals that are set by the EU, and also to achieve a 55% greenhouse gas reduction by 2050, I think. And you can see sort of there's different sectors need to pay a different part of their price. And we then sort of looked at this into more detail to say, hey, is there enough money to pay for this, and can companies actually pay for this themselves? So a similar thing that again, the study from OXFAM France also showed. And this might be a little complicated. It's you don't have to focus on this too much, but the bottom line is really what you see on the left hand side is sort of the really big pot of cash that's been saved, and on the right hand side, this annual net profits shows you that there is a lot of profits being made annually, and both of that could be used for the additional investments that are in red in the middle. And so the bottom line of this is to say the money is there. You could pay out this. You could use the money to invest and then still pay out some profits. So the argument, if companies are constantly calling for more subsidies, is a little bit sort of tricky, because at least for some sectors, you can say they clearly have the money and they wouldn't necessarily need a subsidy to invest into the green transition. Yeah, and one last thing also on the remuneration. This slide is just to highlight how much of a CEO's remuneration is fixed and how much is variable, because you can see, so for 2018 and 2019, it doesn't really vary that much, but you can see a large part, above 70% of what a CEO makes is actually variable. So it's tied to goals. And these goals are very often developments within the company, such as a higher stock price. And so if you already have the CEO of the company that is sort of focused on creating a higher share price, and you have the shareholders who are also it's also in their interest to get a higher share price, then you have two groups that are sort of aligned here already, that want the company to have a higher share price in the short term, and we would argue that is not necessarily something good in the long term, or it doesn't always mean that it's good for the long term, because, for example, the inequalities in labor and wage share along the production line are not considered, or also because they do not take climate risks seriously enough. And and then I will just leave you with some of the policy recommendations that we made in this report, just very briefly. One thing that we can talk about more later, also if we have time, is that in Germany, you have this note actually in the constitution where it says companies are required, or not companies, but like private property is required to serve the public good, and that also includes companies. And so we would need to introduce effective regulations, because it does say that in the constitution, but it doesn't in effect in law. This is not what's happening, at least with what we are showing. And so this is something that could change, where you can actually make companies more responsible for their actions and put this into law in a way that you can actually take them to court and argue about this. The second one is that you should really you can limit shareholder payouts. You can make sure they don't pay out more than they earn, and they don't pay out when they don't earn or when they have lost years. And really ensure that they make the investments necessary for the social ecological transition, because the money is there. They just also have to spend it. But for that, you also need some political regulation. And the third one is also something that Caroline mentioned, where we say at the end, well, there is sort of not the same diverse group of people are present in the board. So you mentioned this also in your presentation, and I was just touching upon it on the last slide. Like if you have, the shareholders very present and also the CEO very present, and all of them focused on share prices. Share prices is not necessarily something that profits employees as much if they don't earn shares, or if, for example, like in Germany last year, a lot of these companies put in furlough schemes, so short-term work, where they don't get employees don't get paid their full wages because of its time of crisis and because of COVID, and not everybody could go to work. And so that is a sensible policy in a lot of ways, because it saves jobs. But at the same time, these companies like Daimler or VW or BMW, they all still paid out dividends. So they paid out profits, but at the same time, their employees were not receiving their full wages. And so this increases inequality very, very clearly. And that's an issue. So I'll leave it at this, and I was, we'll jump into discussions in QA now, and I will stop the screen sharing, because then we can actually look at each other a little more comfortably. And maybe first of all, I'll ask you, Caroline, would you like to make any comments at all on the presentation from Germany? Has this sort of resonated with things that you've been working on? Was this something that you found surprising, or maybe not so surprising?
Yeah, thanks, Michael. I mean, clearly, like your findings echo ours. What I think is really interesting is also like the way in which like you have been able to dig further into calculating like what's basically the investment gap. Like this is probably how we can call it, like into the energy transition. And I think it's important to remember that. Well, first of all, as you said, and as you were able to demonstrate, companies have the money. They have money to invest into the energy transition, and that's a choice. It's a choice that they take when they distribute or not. Or so it's basically, how much they reinvest versus how much they retain. So that's essentially like the big difference. What I think is also important to note is that why is it difficult to actually calculate this investment gap and give a magnitude of what we are talking about is also because we don't have any regulation on climate objectives for large companies. So there's no big framework of how climate objective, what they should look like. And then from there, like what transition pathways and investment plan should be associated with such objectives. So that's another part of the missing another missing part of the puzzle. But I think it's important to have this in mind, is that we are able to give orders of that magnitude, but it's something that also requires further regulation.
Yeah, thank you very much. I mean, that is very true. And that's something that I didn't mention so specifically, but we discussed it also in the report, that you need to have data, and you need to have information of sort of what companies are planning for the future, and also to be able to mirror this and to see, okay, what is sort of needed publicly, and what is being achieved privately, and where do you need more government investment, and where do you need more private investment, and how do you get there? And if you don't have any information on that, and if it's all sort of in the dark, then it's very hard to move forward. I wanted to ask you again a little bit on your, and we'll get to some other questions later. But first, I wanted to get you to ask you again on the reception you've had sort of for these reports and for this work you did in France. So we've just published our study in November. I can briefly say that it was interesting, but we got a lot of media coverage. But and we sent all these data beforehand to companies and just sort of see and see what their interest is. And most of them were fine, and some corrected like small amounts on the numbers. But overall, everybody agreed on sort of what we wrote. But it wasn't a huge news topic or news item yet, because I think a lot of people sometimes maybe even accept it as sort of a given. This is just the way it is, and maybe you can't change anything about it. I don't know. And I would be very curious to hear what the discussion is like in France, and sort of what was your experience when you launched these two reports, and you've been working on this issue for a while, of course.
Yeah, thanks. Yeah, I think for the second report, we've had a very similar experience in France. What's interesting to note is that for the first report, because as I mentioned, like it was published like around the time where there was a law in progress, like a law that that branded itself as being very transformative for the future of business, and ended up being not transformative enough. At least that's our appreciation. But anyway, like because it was published around that time, like it got a lot of media attention at the time, and that also informed the debate in some ways, which was not exactly the case for the second one, because of there was no legislative process taking place at the time. But what's also interesting is that I think because we were able to go deeper with the methodological approach in our second report, because instead of looking only at profits, we looked at added value. That has been positively received by many observers, including companies such as yourself we interacted with, as well as policymakers and media in general. But I just want to mention, like, and I've mentioned this study, Einstein study, that was commissioned by the European Commission, which actually have like findings that are actually very similar to our respective reports. This study has been criticized and has been the focus of a lot of opposition in general in the public debate. And I think, and it stems from the fact that, I mean, in my view, and that's the same criticism that we got on our report, is that it's like, as you said, maybe it's accepted that this is the way things actually happen. And so conversely, like there are observers that say, actually, like there's no connection between the fact that you have high payouts and there is a lack of sufficient investments into, like, if you take only one issue, the climate transition, but of course there are many different issues. And we fundamentally disagree with that. And that's why we are also demonstrating, but that's where the debate is at the moment, I think.
Yeah, thank you very much. I mean, this sort of, I think it fits well to include a question from the audience here from who writes, what do we think is the reason why net profits have increased and the payout of dividends has increased even more? So why are they paying out more? Is this a sort of a change in regulation or a lack of regulation, or are there other macroeconomic regions? Is there a change in shareholder culture or increased competition? And I would like to hear, do you have any thoughts on this? And then I can also maybe share some of the thoughts from our side.
Yes. I mean, I mean, at least our analysis is that it's a result of a gradual process of increasing financialization of large companies in France, but also outside of France, that has happened over the past 40 years, roughly starting off from financial markets deregulation in the 80s. But essentially, I think it's really just like the financial sector has doubled, like the global GDP of the financial sector has more than doubled in the last 40 years, and this necessarily results into transformation into the rest of the economy. So now we live in a financialized economy, which essentially means that companies have to take into consideration way more the interest of financial actors, and financial actors value their shareholders. If you look at the prevalence of financial actors in the shares of large companies, financial institutions, institutional investors, etc., like those have increased quite a bit in the past 40 years, and so this naturally results into a change in the way in which decisions are taken by large companies. But a bit more specifically in France, what we have also observed is that the share of added value that goes to the state in the form of corporate income tax has gradually decreased as well, as a result of different reforms introduced in France, as well as a result of different tax incentives for large corporations. So the effective tax rate has effectively decreased. And so, this is a way also to increase like the rest of the share that goes to other actors. And then at the end, at the bottom line of company's profit and loss accounts, the profit, and then the share that you can give to your shareholders.
Yeah, thank you. That is very well said. And that, yeah, you kind of sort of put it in perspective a little bit again with the historic part and how this is not a trend that has started yesterday, but it's sort of a trend that has increased with the increasing influence of the financial sector, and how real economy companies, so non-financial companies, not banks, have become have started working more like financial companies, and have to pay more interest to the investors. And I would agree with this. And to add on this question a little bit, this is a trend. If you look at the same graph of payouts increasing substantially, and you increase the timeline, so not just 2009, but you go back to 2000, for Germany, France, but also UK, Netherlands, you can see that the payouts have increased even more. So this trend is sort of started in the early 2000s in Europe, or in continental Europe, and in the UK and in the US it has increased even further a while back. And I think a lot of it is related to this overall trend of financialization, but there were also some changes in regulation, at least in Germany, or some changes in the overall attitude also. So for the Germans in this discussion, there is a word that used to be dropped a lot. It's called the term, the Deutschland AG, so the Germany Corporation, used to be called in the 90s and before, with and it basically spoke of how entangled the corporate elite was, and how every German public company usually had at least one person from a bank on their board, and how everybody sort of knew each other, and how that wasn't really good for growth and for all these issues. And that's why you had to liberalize this a lot more. And this is what happened like in a trend over the 90s, and where you also see that a lot of companies were introduced to go public. So like the German Telekom and the German Postal Service, and a couple other prominent examples have been then taken to the stock market. And so that's sort of one of the questions to answer, or to add on to this question. I actually saw another question in the chat that I can't read from whom it is, but it says, when challenged, how do directors usually justify paying dividends in lean years, and how would you respond to their argument? So how do they justify paying dividends even though it's not going well? Maybe we can look at especially last year or this year, which have involved sort of crisis years at times. Caroline, would you like to share your thoughts on this?
Yes. So essentially, I mean, the answer to this is that you pay dividends. I mean, the technical answer. The technical answer is that when you decide to pay dividends, you don't only look at, I mean, as a board, you look at how much the company has in reserves, then you add the profit, and that gives you the pot that you can actually distribute. So if you had reserves before from undistributed profits, and you make zero profit that year, you can still like distribute part of your reserves. That's technically possible. So that's how it happens, really. Just to explain, like it's not magical. It's not magical at all. But I think so. The way we have approached. So this is what companies answer. But we think it's so. There are a couple of answers to give to this approach, and why we think that needs to be rethought. First, it's important to also look at the reserves that are part of the company's equity as like money that they can also use to support other type of investments. If equity goes too low, that's dangerous for the company. That's dangerous and that makes them impossible. That makes them incapable of doing sufficient investments. So when you decide to distribute your reserves, that's something that need to be taken into consideration. And just more generally, and that's actually an approach that we have seen a discussion coming up a little bit on that during the COVID crisis with regards in particular to banks. I think at some point the European Commission, the European Central Bank said banks should make sure they don't distribute all their profits and keep enough as part of their equity. Reserves are part of the equity because it makes them more resilient for future financial shock, and essentially reserves are a buffer also against future losses. So if you distribute reserves, like probably that's not super cautious as well, even from just a purely economic standpoint.
Yeah, again, that's very well put. And comparison is something that we made a lot also because you have this you had this regulation in place for a while in the financial sector by the ECB that said, okay, you're not allowed to distribute or you should not distribute because it's a crisis time, and we are helping you on the one side with sort of making the regulation lighter in times of crisis, and that's why you shouldn't be paying dividends. And in a way, that's exactly the same discussion that we had in Germany and that we Finanzwende sort of focused on with the campaign also in the past year to really push the button on the one hand receiving government aid and state aid, and at the same time paying dividends. And so I think you already really focused on the right issue, that sort of it's not just the profits of the 1 year, but you can always say, well, we've been very profitable in a lot of years, we've already saved a lot, we have all this that we can pay out. If I were to challenge this, or if I had to challenge this, I think one very clear argument that I always like to make is that this is all often very short-term oriented. This idea of paying things out right now and being able to do this now. The question is, will you still be able to do that in 10 years? And with some companies, or even in 15 years? And with some of these companies, those are serious questions, because their business model might not be able to last, at least not in the way that they have it right now. Like energy companies in the cement industry, like the building industry, there are a lot of things that are changing and that have to change and that are already on a very clear path to change, and yet they have not invested and changed their business model. So this will not be good for shareholders down the road. I mean, if you receive a dividend, a euro here per share and another 2 euros here per share, that doesn't mean that you will ever get back your initial investment, because if the company at some point is worthless because their business model just doesn't work anymore and regulation has changed, then you still suffer a larger loss. And so this is not, this is nearsighted, and it's not the way that it should work. And so I think this is also important to add to this. Do you have any other thoughts on this? I mean, one of the things that we didn't touch upon now is sort of this. Just to mention briefly, this is economic theory on dividend smoothing, and I think we've both kind of addressed this without actually naming it. So this is one of the reasons why companies think they need to do this, because they think that their investors, their shareholders, are expecting these payouts already, and then that's why they are doing this again and again and again. Maybe briefly before I look at the other questions, Caroline, how was the discussion in France? Was there any discussion around these furlough schemes, this government aid, and then also paying out profits at the same time, or was this not a topic?
Yeah, no, definitely. It's been a topic, and it's been a topic for us, but also for other organizations that have looked at this, and we essentially completely share your arguments. There's no logic in here. We tried to that's a discussion that went also. That became part of the legislative process on the economic package, and so where some MPs argued that there should be conditions to state aids, such as not distributing dividends or capping them, or like any sort of regulation of that for this reason. But this has not passed. So that's definitively something that we consider that it's not normal.
Yeah. Okay. I think we have time for 2 more questions. One, I think that is a little bit shorter but interesting, by Dr. Artemisa Montes Silvan. She asks if we identified a correlation between increase in debt and the payout of companies. And I think this is sort of a very interesting question, because I think in the UK and US literature, there are some correlation that that has been estimated, but I think in Germany and France it's a little harder to say. Caroline, can you share on your thoughts?
No, it's definitively hard to say, and especially correlation is really hard to establish. So if you want to be careful on that, it's very likely that there is some connection in there, probably also because loan rates have been quite low, so there's an incentive for companies to go into debt. But that's not so we tried looking at this, but we were not able to establish a correlation, to be honest. But I think that's not necessarily the biggest question for us, at least in all of this, because we think it's okay for companies to go into debt if that's money that they borrow to invest into transforming their model. So that's where the question really is. And so this is what we see. What we see now is companies not investing enough, and I just wanted to add a point on like just coming back on we're like on the reception and comments that have been made. The comments that often are made around all of this is that why would you not distribute like dividends to shareholders? Those are profits that have been made, workers have been paid, investments have been made. This is what's left at the bottom line. So why would you not distribute? Like what's the point? And so I think it's important to remember that we have talked about the investment gap and the fact that there is not enough. But like if you only look also at like workers, but also human rights violations, like we have also studied as OXFAM and demonstrated in many cases that there are large companies that pay very high dividends that clearly are involved into human rights violation in the form of not paying decent wages to workers in their supply chains in many countries in the world. So it's so basically if they were to increase that, that would decrease their profit, probably. That would mean less dividends. So that's the way this needs to be rethought.
Yeah, that's well put. To just add on this very quickly, in Germany, this is not has not been that much of an issue yet, because these last years have been very profitable for these companies. So they've been able to just pay it out of their earnings or out of the reserves in cases that they didn't have of the lost years that we showed on this one slide. But really, it's a question for the future and also for 2020, because in 2020 you could see that some companies have still paid out, or in 2021, sorry. So in 2021, this year, you could see that a lot of companies still paid out profits for the year of 2020, which was not really that profitable of a year for a lot of these companies. And so this trend continues. That is very worrisome. And then maybe now we go to the last question, because there's only 4 or 5 minutes left. And there were a couple of questions sort of along the same lines. One by Inge Brecklein, who said, okay, what should politicians do about this? What can be done? And then another question on if we expect any positive changes from EU regulation. So I'll pass it over to you.
Especially. So what can be done and what do we expect from the EU regulation? Like those are connected and intertwined questions. So what can be expected from the upcoming EU legislation, as maybe some of you know, the proposition of the directive was supposed to be published this month and is postponed until March. This is the second time it's postponed. What we know is that the ambition of the Commission was quite high, quite commendable actually. When you looked at the part on directors' duties and governance reform, they looked and mentioned remuneration packages, not really dividends and distribution of profits, but the role of boards in providing oversight on strategies that then impact the type of investments that are made, and then further down the line, investment and profit distribution. This was all clearly mentioned in the initial roadmap. It's not quite clear what will be the level of ambition of the text that we will see in March 2022. What we know is that there have been lots of interest from business lobbies and many corporations on this text, and probably trying to water down the ambition of the Commission on this part of the text. So that's quite worrisome. I think it's important, for those interested in the topic to actually, look at this legislation in progress and get some more public interest, I think, in this text, because it can get quite technical. And as we have said, but I want to maybe stress it again, like the problem is that we all, not all, but a lot of people take for granted, like the way large corporations function. But capitalism is also, and the way capitalism functions today is also a function of recent history, as we have mentioned, and also was really not, has really evolved in the past 40 years, but also over the past century. And more than a century ago, states actually were worried that large corporations someday will have too much power. And today, maybe this is what we are seeing. So it's a constant evolution, and so we all probably need to get interested in this to actually make progress.
Yeah, thank you very much. That was again very, very nicely put, and I don't even want to add that much more. I think maybe I can focus on one thing that has been part of the public discussion in Germany a little bit, which is sort of new forms, new judicial forms of a company, sort of new law forms. So not having publicly listed companies, but sort of changing the form that the company is in, and sort of protecting it from too much shareholder interest or too much shareholder pressure, financial market pressure, but also even if it's a family company and going to be inherited from someone and maybe have to broken up, etc., to be able to put this into a different form so that these things are a little bit more long-term oriented. And this has been a discussion. Last year, I think there was a proposal on this sort of by several economists and lawyers, and it was discussed for a while, and it got kind of pushed away again. But we can see that you have a couple of different forms of companies around that actually do work pretty well. And so this is something to think about more, where you can also kind of think about changing this. And on the other side, obviously, the answer that we made in our report was to say that we need to change the law a little bit and to actually introduce this pressure that as long as you are making all these profits at the expense of social and environmental costs, that you shouldn't be paying them out, but you should be using them to sort of address these costs that you're producing at the same time. And so that is something I think that is an inherent problem of capitalism, that a lot of the profits are being made while certain prices aren't being paid or don't have a price tag on them yet. So this entire discussion is obviously this entire discussion on carbon prices, etc., is very, very crucial. But I think now we are actually right at the end of the hour, and I would like to thank you again very, very much, Caroline, for joining us today. I think that was super insightful, and also for providing the inspiration for this report that we then wrote here in Germany.
Well, thank you. That was my pleasure. Really interesting discussion.